Welcome back, everyone. Today we're going to be looking at 10 stocks that I'm waiting to buy. Now, you know me and my portfolios. I'm always looking for high quality companies. In fact, my whole investing philosophy is based around investing in the best companies in the world, ones that I think have incredible growth potential, very wide moats. And then when I find companies like this, I like to make them large concentrated positions in my portfolio. If we look at the Story Fund, for example, we have Amazon. I think it's just a juggernaut. It's a very advantaged company. We have Netflix. This one doesn't have as much of a consensus. I know a lot of people are wary about Netflix, but I have a high degree of confidence that this is going to be an extremely prosperous company in the future. It has a much wider moat than I think most people believe. Then, of course, we have some other tried and true names like Google, S&P Global, which is just another juggernaut, and of course, Microsoft, which is another giant beast of a company. I don't mess around with my investments. I invest in companies that I think are the best of the best. And even though I only have 5 positions in this portfolio and a handful in my other, I'm always on the lookout for new companies. I'm always researching stocks, looking at them, looking at different ones that people present to me, different ideas, and I get a good idea of what I like to invest in. Today in this video, we're going to be looking over 10 companies that I think are worthy of the Joseph Carlson portfolio. These are 10 companies that I would buy given the right opportunity. If the price was right for any of these companies, they could potentially make it into the portfolio. So we're going to be going over each one of them, and I'm excited to jump in. In number 1, we have Toast. Now, this may sound like a new stock. I haven't actually talked about this one a whole lot, but this is one that I've been secretly researching behind the scenes. And from what I see, I really like what I see with this company. First of all, to just give a brief description of what Toast is, on Qualtrim here, the website that you can have access to if you're a Patreon member, it gives you a brief summary of what it is. It operates a cloud-based digital technology platform for restaurant industry. Saying that they're a cloud platform for restaurants is another way of saying that this is basically a company that you would sign up for if you were to start a restaurant. So for example, if you want to start your Italian heritage pizzeria that's on the corner of the street, and you want software to be able to manage point of sales, you want to manage your tables, you want to manage your takeout orders, and you want software that's highly tailored to your pizzeria, they literally have pizzeria software. That is how specialized and tailored it is. Or if you're a fine dining restaurant, they have software for that. Or if you're casual dining, or if you're a cafe or bakery, or a bar and lounge, or brewery, or food truck, or a hotel, you get the point. This company specializes in restaurant software. The specialization gives them an extra moat, a competitive differentiation between a simple point of sale solution. Right now, Toast has 120,000 customers signed up using their software. That's a lot of restaurants. And it's true that restaurants is a tough business. Many of these restaurants will fail, but at the same time, many of them will grow their sales. As they grow their sales, Toast makes more money. So in a way, this is a company that has a bit of a license on the revenue of all of their customers. As their customers grow and become bigger, they open up multiple locations, they sign bigger and bigger deals with Toast. So this is a company that I find the product intriguing. I like that it's a digital marketplace. I like that it's a platform that specializes in a very specific industry. I like the industry that they specialize in being massive. Restaurants are a massive industry, especially small restaurants. And if you've followed my channel, you know that I believe restaurants are going to become bigger and bigger over time. When I look at the valuation of the company, that's where I become a little bit more concerned. Right now, Toast has a lot priced into the stock already. It's at a $16 billion market cap. It has a 1.2% free cash flow yield. And if we look at some of the metrics like the free cash flow, right now they're in that phase of growth and figuring out their finances where their stock-based compensation is still more than the free cash flow they generate. So they're really not producing profit right now, but you can see the trend. It's going up over the past 6 quarters. Soon enough, they're going to be producing profit. And I like seeing that trend over time. I like the free cash flow going from heavily in the negative into the positive on a consistent basis. I like the revenue growth, how it's a step up every single quarter. This is SaaS revenue growth, and it grew a staggering 30% year over year last quarter. based on a trailing 12-month basis. Toast is also a business that I believe fits well within my portfolio. You'll notice a lot of the qualities from Toast seem similar to Booking or Salesforce or Intuit. It's one of these companies hyper-focused on a single market. The market they're focused on is really big. They are asset light. They just have a lot of developers they need to pay. But other than that, there's not a lot of CapEx. And I believe the total addressable market for this company is massive. So even though they're growing revenue quickly, I think they have a long runway. So if I see a big dip in Toast stock price, providing me an opportunity to pick up this company at a cheap price, I may be taking advantage of that. Now we move on to number 2, which is CrowdStrike. This is a company that's more familiar. I've looked at this one. In fact, I own CrowdStrike for a short period of time. But I've been looking to get back into this company because I find CrowdStrike to be an extremely strong SaaS-like company, but for cybersecurity. It is true that CrowdStrike had that bungled content update, but I think they've learned their lesson. That's something that I don't think they're ever going to repeat again. That was something embarrassing for the company. It was a black eye for it. But even after that black eye, CrowdStrike is doing well. If we look at the company on a trailing 12-month basis and we look at the revenue, it really has not slowed down this one. CrowdStrike is growing at 33% per year as of their most recent quarter. I believe the revenue growth is going to continue. A lot of companies right now are extremely concerned of breaches, and that's what this one does. They stop breaches. They stop companies from taking over computer systems, locking down your company, and making it so that you're extorted and forking over millions of dollars to unlock your company. CrowdStrike prevents all of that. The fundamentals of CrowdStrike are phenomenal. If we look at the percentage of the revenue that is subscription-based, we have it broken down right here in the revenue segment. We have subscription in dark orange, and then we have professional services, which is the non-subscription portion, in the light orange. You'll notice that the subscription portion is around 95% of the revenue. So virtually all of the revenue they make is from subscription, and they have a net revenue retention that's above 100%, meaning their customers on average pay more per year than less. So this is a very good, highly reoccurring revenue company. And I really like these type of businesses. I like it in retail with companies like Costco. I like it with Microsoft. I like it with every type of company I buy to have some type of reoccurring nature because it makes the company more predictable. Now, they also have total performance obligations, which are basically forward-looking revenue that is continually going up as well. So even though we can make predictions about revenue in the future, this makes it a little bit more certain. In Q1 of 2024, their most recent quarter, they had $4.6 billion of obligations, which is money that these companies have committed to use with CrowdStrike. Now, again, with their recent hiccup, with their update, some of these companies may roll out of their contracts. Some of them may cancel out of concerns. But if I was to make a guess, I think it's very few. I think very few customers are really going to cancel CrowdStrike over this. So we may look at that and see what happens. Maybe if some customers cancel, it'll bring the stock price down and be a buying opportunity. But overall, I see continued growth with this company at a very high rate. Another thing I like about CrowdStrike is the free cash flow line of the company. It paints a very good picture. You see they have very predictable growing free cash flow, exactly what I like to see with these companies. When I even look at it with stock-based compensation, this looks a lot uglier because the stock-based compensation there in blue is eating up a lot of the free cash flow, but they are growing even adjusting for their stock-based comp. For example, if we look at the net difference here between the two numbers, you can see that it's starting to take off in the past 7 quarters. That is a trend I like to see. I like the company, I like the product, I like the CEO. I realize that he made a big mistake. That content update, again, is a huge black eye. But I think give it a 6 months or a year, and people are going to forget about that. It'll kind of go away with history. Companies have these type of events come and go, and overall, it just depends on how they continue to keep their advantages with the product. Right now, CrowdStrike is the go-to name for enterprise cybersecurity. So I look at this company and I really like it. The reason that I'm waiting to buy it is because of the valuation. When I enter into a new position, I want to get a deal. I want to feel like I'm getting a lot for what I'm paying. With CrowdStrike, it's up there as one of the more expensive companies in the market. With a forward PE somewhere in the high 70s, a free cash flow yield below 2%. When you adjust out the stock-based comp, it's even lower at 0.5%. That's just really expensive. So even though the company's in a slight dip after this content update, after this problem with their update, it's still not in a big enough dip. I need better pricing. I need better valuation to jump into this company. So as of right now, it's a great company. that I'm waiting to buy. The number 3 company that I'm waiting to buy is DoorDash. This is again one that I owned for a short time, but the stock didn't make any free cash flow. It made no real profits when I owned it, so I thought I should at least wait until it generates some cash to prove the business model before buying in. Now, of course, a lot has happened over the past 2 years. DoorDash has continued to grow. The stock price has been, frankly, all over the place. If we look at the past 5 years, it's been a big bull U shape. So it went down a lot, it recovered a little bit, and here we are with the stock. DoorDash is a company that I like the product. And unfortunately, I like the product. In fact, it's one of these companies where I wish I could just eat healthy, homemade food every single day. That seems like the optimal diet. But there's just some nights where I'm tired. I've worked, my wife is tired of taking care of the kids. None of us have prepared dinner. We could get something out of the freezer. And then I have the DoorDash app, and I just know a couple buttons, and I'll have some yummy food dropped off at my doorstep. And even though I know it's a waste of money, I know it's too expensive, I know there's all the fees they add to it, I know there's all the upcharges, even so, in some cases, I'm willing to just foot the bill and get some good food. I just want to eat some good food without having to go and prepare it myself, without having to go and drive for an hour to get it from a restaurant. And that's where DoorDash comes in. The company preys upon your convenience, your compulsiveness, and that is a good thing to prey upon. Convenience is a great thing for a business to have. And this is what's different between DoorDash and a lot of other companies. The reason that DoorDash gets away with charging so much or having the fees is because people like the service. Making it so that good food magically appears on your doorstep is not an easy feat. And DoorDash has figured that out. Even though there's things like robo-taxis and other potential competitors to DoorDash, this company has a valuable network. And I could see a robo-taxi company working in concert with DoorDash if that ever became a problem. They would just use their network they've already created. The company has incredible amounts of data they gather, and a lot of people don't understand really the math behind DoorDash. To be able to figure out surge in traffic and demand, what to pay everybody, how to network it all together is a very big technical challenge, and this company has already figured it out. So I like the advantages they have. I like the network effects. I do think that DoorDash has a pretty big moat. They share a bit of a duopoly between Uber Eats, but I don't think DoorDash is going away ever. And companies that can stay around for a long period of time typically do really well. Now, again, when I look at the financials of this company, it's certainly headed in the right direction. They have their free cash flow against their stock-based comp, which looks a lot like many of these early companies. But if we look at this, we're looking on a trailing basis here. Let's take a look and you'll notice the trends. The free cash flow is going up, generally speaking. The stock-based comp is holding steady, so you're getting margin between those two numbers. When we look at the net of the two, you can see the trend. See this nice line being drawn here? That is what we like to see. The free cash flow per share is growing at a much faster rate. So when we see companies moving in the right direction, eventually they should be able to justify their current valuation. A lot of the financials are still early and mature, but the company's in a good situation, generating cash flow. The cash and debt look incredibly good. It has a lot more cash than debt. And again, I like the business model. This would be one that I'd like to be invested in for the right price. But right now, the valuation is not the best. This is another very high price company. And to get into this one, I want to wait for a time period where we get some weakness in the stock. So hopefully we get some weakness at some point or another. The number 4 stock that I'm waiting to buy is Spotify. This is one that I've actually owned for a while, and I got cold feet. I got shaken out of the stock. And there's a lot of valid reasons to be concerned about Spotify. After all, it's a music app that's going up against Apple. There's Apple Music, which is huge. It's going up against YouTube. YouTube Premium is huge, and it comes with YouTube Music. And it's going up against Amazon. Amazon has their own music player. So Spotify is like this single company going up against most of big tech companies, and it seems like an uphill battle. Then there's the old debate of how much money Spotify can really make while the music labels control virtually everything. All of these are valid arguments, but what I've observed over the past couple of years is that the bull case I originally had for this company is what was right. Spotify continues to be incredibly profitable despite all of those challenges. And in fact, they're showing incredible amounts of operating leverage even despite the competitors and the music labels. And they're doing that with their control over pricing, with their control over the operating leverage of their business. Spotify is a unique platform because people fall in love with it. Once they start using it, the end of the story is they never stop using it. There's people that are subscribed to Spotify for years and years and years. And even when you sign up for Spotify, you can cancel and you'll try something else out. There is over a 70% chance that you'll end up going back to Spotify within 4 months. So if you sign up for the company, beware. You are ensnared. You're trapped into their ongoing subscription because their product becomes so integral. It becomes so valuable in your life that you realize just other music apps are more annoying. Spotify is ubiquitous. It works with every device. It works with your CarPlay. It works every speaker in your house. It just works with everything, all your smart TVs. And the ubiquitousness of it, the playlists, everything that they have going with this company makes it incredibly difficult for you to switch to something different. So even though they raise the prices $1 to $2 per month every once in a while, the service continues to be something that's very sticky for users. Now, when I look at this company, the biggest challenge, the thing for Spotify to prove was if they can actually generate real cash flows. The whole question for the company is, can they truly generate cash flows? And Daniel Ek, the CEO, said, oh, we for sure can, but he would never prove it. It was always just making around the same amount, barely anything. When you factored in stock-based comp, they were losing money. And investors just got a little bit impatient. I was one of them. I didn't want to wait the next 10 years for them to post any profit. Now, I sold the stock somewhere around 2021. It was never a huge position, but I decided to exit out of it and go into some ones that I was a little bit more convinced of. Spotify had a couple rough years afterwards, and then they had the breakaway year in 2023, where they started to generate incredible amounts of free cash flow, way in excess of their stock-based comp, and their stock-based comp started to go down. So it seems like they proved, yes, we can generate real profits, even factoring in dilution. The last year, they generated $1.45 billion in free cash flow with only $300 million in stock-based comp. So this company is generating a lot of cash, and that's just the beginning. Spotify still grows every single quarter with their total active users. Unfortunately, the stock has just shot up. People are buying into the story, and I'm not going to chase it. So I feel like I missed out on this one. Maybe it got away from me. Maybe it will never come down. But if this one comes back down below a $50 billion valuation, I'll be buying in. But until then, I'm waiting. The number 5 stock that I'm waiting to buy is Palantir. Now, I know a lot of people are going to look at this one and say, Joseph, I thought you hate Palantir. You've made critical videos about Palantir in the past. And that's true. I have made many critical videos about Palantir. But what I do is I follow every stock. I try to give all of them a fair shake. My biggest criticisms for Palantir have been on the basis of the valuation of the company. Essentially, there's 2 different risks to any stock. You can divide any stock into 2 different segments. There is fundamental risk and there's valuation risk. The fundamental risk are things like the moat, the leadership, the products, the marketplace, whether or not the business will have durable growth for a long period of time. There's always risks to the operations of the business and the moat and the competitive environment. That is fundamental risk. Then there's valuation risk. Valuation risk is things like overpaying for the fundamentals. A stock can be really good fundamentally, but you can still overpay dramatically for it. We've seen a lot of people do that in the early 2000s. A lot of these stocks were really good. People overpaid for them, so they got very poor returns. With Palantir today, I believe the stock has come a long ways over the past 2 years. I've seen a lot of developments with the qualities of the company in a positive manner. They've grown out their commercial business. They've engaged in a lot of contracts. They productized a lot of things that were done through consulting. They've done a lot of developments that I like to see with the company. So fundamentally, I see the company moving in the right direction, and that's good to see. I love seeing fundamentals improve for any stock. Unfortunately, the thing keeping me out of it right now is the valuation. So right now, I view the fundamental risk as lower for Palantir. In fact, I think it's rather low. This company's going in a great direction. It seems like it has a great product. So low fundamental risk, but very high valuation risk. I think the valuation is concerning when I look at it. So this is one that I've gone over the case of. I've looked at Palantir. Again, I like the company. I like what Palantir does, and I like the leadership, how bought in he is in the company. I like the balance sheet, the growing earnings per share, the growing free cash flow that is growing above the rate of the stock-based compensation. But right now, again, the thing keeping me out of this company is the incredibly high valuation. And I think any investor in Palantir should know that when you're looking at a company that has an 84 PE ratio, free cash flow yield below 1%, or even a price to sales of 33, above a 30 price to sales, all of that means that there's a lot priced into the company. So as someone that's looking at potentially buying it as a new position, I like to get a lot for what I'm paying for. Again, I'm always trying to get a good deal. Even for a good thing, I want to get a good deal. I never want to feel like I'm paying top dollar for a stock. That's not a good feeling. Now, you may say, Joseph, you've been covering Palantir for years. Why didn't you buy it when it was trading at $7 per share? And it is true. If we zoom back just a couple years ago, it was $7 or $8 per share. During this time period where Palantir was $7 or $8 per share, there was a lot of other companies that were also very cheap at that time period, ones that I was very laser focused on. We can look at the similar stock price of Amazon. Amazon was going through all sorts of troubles when Palantir was cheap, early 2023. I was pouring money into Amazon. We have another stock that was going through sorts of troubles during that time period. Netflix was another one that dived in 2022. I was pouring money into Amazon and Netflix and Google and Microsoft as well. Between the big tech companies that I was pouring money into, my focus wasn't on many other positions. I already felt like I had some really good buys at the time. So it is true that Palantir has been cheaper in the past, but during the past, a lot of other great companies were cheap as well. My focus was elsewhere during that time period. But if we get a situation where Palantir, for some reason, has a big dip and the rest of my portfolio is doing just fine, this is one that I could enter into as a new position. I really like the direction they're going. The number 6 stock that I'm waiting to buy is FICO. Fair Isaac Corporation to be exact, but they're moving their name to FICO. They're embracing the FICO score, and that's mostly what this company does. FICO is broken up into 2 different business segments. We can take a look at those with Qualtrim Insights here to give an idea of these 2 different segments. We have here the scores business. That is the main business that most customers know about. Scores, of course, are your FICO score, and they are origination scores. So they're not really used for credit cards or opening up little lines of credit. They're used for originations of big purchases. If you're purchasing a vehicle, if you're purchasing a home, those are going to be based off of FICO scores. Now, FICO has become an industry standard. It's a language protocol. It's basically like English to the business language. FICO is to the origination language. FICO is so synonymous with scores that they are indistinguishable at this point. In fact, most banks, most big lenders will not lend big loans to anyone without a FICO score. So it has become the de facto way to give credibility to someone. And we're in an environment where everyone relies on credit for virtually all of their big purchases. Now, scores is the largest portion of your business, but they also have this software portion here. This is the part that most investors, and I think even most customers, don't know about. It's the same type of deal with Moody's where they take the credit rating portion and they combine that with a lot of analytics and they sell that to their customers. FICO does the same thing. They sell a lot of different business solutions that they gather from analytics based off of the scores data that they have. So this is another situation where they use the monopoly that they have, which is their scores business, to benefit creating another business, which is their software business. Over the past 10 years, FICO has carved out this incredible position in the market and used that to leverage their price increases. They know that they have saturated the market and they are ubiquitous in scores, and they've used that to lean in to price increases because they know customers aren't going to complain. If you consider this from the customer perspective, when you're buying a home that costs $600,000, do you really care if the FICO score is $1 or $1.30 or $1.50 or $2 or $3? You don't really care. In fact, you probably don't even know. It's not even a concern. When you're in the mind frame of buying something so big as a home or a brand new car, the FICO score is the last thing on your mind. So that gives FICO the ability to increase prices by 100% per year. They can increase prices from $1 to $2, from $2 to $4, and they have been doing that. Their pricing power has been incredible, and that's caused the stock to grow in its free cash flow like crazy because the stock has incredibly high margins. It doesn't cost them anything additional to increase the prices of their score by 100%. So nearly all of that price increase drops to the bottom line. This is one that I think is a great company. It meets a lot of the qualities that I look for. Unfortunately, I didn't buy in when it was at a cheaper valuation, and now it's raced up to a $1,900 price point. So it's a very high valuation, another 64 PE stock, 1% free cash flow yield, and I find myself patiently waiting for a big dip. The big dip may never come in FICO. Maybe I've missed this one for good, and I'm okay with that. I'm a patient investor. If I never get a price that I think is really attractive, I'm fine never buying the stock. So I'll continue to be patient with this one, and like any stock, I'll be opportunistic if it dips. The number 7 stock that I'm waiting to buy is Chipotle. This is one that has been in the portfolio before. In fact, I recently sold out of it earlier this year. I sold it because the stock was going up to a valuation that I thought was just a little high. It was a bit above the range that I felt comfortable holding. And I'd made around $11,000 of gains in the company. As a half-size position, that's a lot of gains. It raced up really fast over the past couple of years. I bought it around this time period, somewhere around here, and it just rocketed up. So I felt like it was a good trade. I bought a company. It had a lot of bullish sentiment. They had same-store sales grow consecutively. They beat out virtually every other restaurant except for Texas Roadhouse and Wingstop. So there's like 2 or 3 that did better. But Chipotle was up there as one of the top best performing restaurants over the past year. With so much positive things going and people paying ever increasing prices, I decided to take some gains and run and give this one time to breathe a little bit. If there's some quarter that they give soft guidance or their same store sales comes in way below expectations, the stock overreacts. It drops 10, 20% in a single day. And everybody's scared about Chipotle. Everybody knew it was going to crash eventually, right? Those are the opportunities I would look for to buy back in this stock, get my position at a lower price. If that opportunity never comes, if the stock just rockets up forever, that's fine as well. Again, I'm a patient investor. I'll wait until there's opportunity to buy these companies at a reasonable price. Number 8 stock that I'm waiting to buy is ServiceNow. This is another company that I've had my eye on for some time. I've covered it in other super investors' portfolios. I've looked at it through the basis that I do most technology companies, and I really like what this company does. They try to automate everything. It's a company that's growing very fast, and with that fast growth, it also maintains a very high valuation. So while, again, this is one of the companies that I love the fundamentals of, look at this revenue growth. It's just beautiful. It shows recurring revenue growing quickly, high net revenue retention rate. It grew 24% year over year last quarter based on the trailing cash flows. We look at all the other metrics, and again, they're growing likewise. Even the free cash flow is growing very fast. 30% per year. We look at it on a stock-based compensation adjusted basis, and you see that they're growing that margin between these two numbers, so they have real cash flows growing over time. You can see this in the free cash flow per share. It grew 31% year over year. I want to get a lot for what I pay. I don't want to pay top dollar for these companies. So even though I could buy ServiceNow right now and pay a 53 forward PE ratio and a 1.7% or 0.76% stock-based comp adjusted free cash flow yield, that's a lot of money to pay for this stock, even given its bright future. With ServiceNow, this is one that I would add to my portfolio because I like the qualities enough, but I need to get it at the right price. So I'll be looking at this one from time to time, seeing if we get a reasonable dip, seeing if there's any type of bearish sentiment in the stock. We've made it to number 9. The stock that I'm looking to buy in number 9 is Adobe. There's a lot of debate over Adobe right now of whether or not this company will benefit from AI or be hurt by AI. I think there's valid arguments to both sides of that. But what I think a lot of people miss with Adobe is that their creative suite and the tools behind it are only part of their value that they provide. If you look at the revenue breakdown from Adobe, it is true that a lot comes from the digital media portion. This is the Adobe Creative Cloud. But a lot of it comes from digital experiences, publishing, and advertising. These are different things like document signing, PDFs. There's lots of different cloud services they offer. So a huge portion of this business, I don't really think is threatened by AI. I can't see it really threatening all of this revenue. And even within the digital media, there is valid arguments that AI will help them. But most importantly, Adobe's a company that has massive concentrated market share in the creative industry. There's some companies like Figma that threaten them with design, but in terms of art and video creation, Adobe has a huge lead in concentration. So I think this company should not be underrated. It's one that I still look at from time to time, but I need to get a good deal on this one as well. There are some concerns I have about Adobe, some challenges with it. So to buy this one, I need it at around a 4% free cash flow yield. If I can get this one at a 4 to 4.5% free cash flow yield, I'm in. I'll be buying it. Now we've made it all the way to number 10. The stock that I'm looking to buy, unfortunately in this case, is not an actually publicly traded stock. So it's one that I can't buy right now, but I'm very excited for when this company eventually becomes a publicly traded company. The company is Anduril. It is the defense company that's started by Palmer Luckey, who also started Oculus. He changed his attention this time from Oculus to Anduril, which is this company that creates a system to navigate different devices specifically on drones. Now more than ever, wars are being fought with drones. These are the new 21st century war device. They are taking over the battlefield. We've seen this in the Middle East, we've seen it in Ukraine and Russia. Drones are being used for virtually everything, for launching missiles and attacks. They bomb different things, they get surveillance, they have cameras. And why not? Drones are things that you can launch from a distance. They can be remotely controlled. They have all sorts of different uses. Unfortunately, a lot of those are terroristic uses. So drones can be used to attack things like concerts, like venues, football games, stadiums. They need to now look at protection from drones. And there's companies specialized in doing just that. Anduril is a company that has an operating system called Lattice. Lattice is their command and control center. So it has a central operating system, an OS, for all their ancillary devices. They have these advanced drones that they're developing that work in conjunction with this central operating system so that they can remotely do update after update and fine-tune all of these physical devices. In one of their presentations, they show off one of their devices here called Roadrunner. And this is like this incredibly powerful drone that basically, if we just skip ahead here, they launch this thing, it flies through the air. It calculates mathematically the best way to intercept this other drone or this other jet that they're trying to stop. And you see what happens here. It just goes right through it. The thing just explodes. Now, it's not the Anduril drone that's exploding. In fact, that thing's just fine. Now, normally I don't think defense contractors are that interesting of businesses. I don't invest in any of them myself, but that's mostly because of their very obscure business model. In the case of Anduril, the way that Palmer Luckey has described it is it's very much billing like a normal software company where they create products and they sell them to the military. They don't get big contracts where they have to develop the product after the fact. So they're doing the front work. They're developing all these amazing products. Then they go to the military or to the US, and then they sell the products on an ongoing basis, a contractual ongoing basis, which feels very similar to a subscription basis. But instead of doing it for just normal customers and normal civilians, they're doing it for the government. So I also really like the business model they're building behind this. I think it's good for Anduril. I think it's good for the US. And I think this company is going to be very successful. Now, there's no official IPO date, but there is speculation that the company could IPO in just a couple of years, 2026 or 2027. And this is one that I'd be very interested in buying into if it IPOs. And that's it. That wraps up the 10 stocks I'm waiting to buy. That's all for now. See you in the next one.